What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, at the request of somebody on After Hours from Terrified of AI, he says, I know that you're a math teacher and you teach high school students every day of your life. He goes, what indicators, what things do you look for in the market as a mathematical, logistical kind of person here? So today's video is bringing you that idea, what I look for, things that I've learned over my many, many years of taking math classes, and kind of where I can potentially apply it and see how it applies to the stock market. So if you're excited for today's video, feel free to like the video, subscribe to the channel, and turn on the bell notifications for all future uploads. Now, with this video, I'm looking at 3 major ideas, and if I have time, I can give you some other ideas that I've learned over the years from teaching at a high school level. I teach AP statistics, so if you are someone watching this and you took that class, hopefully you passed. So without further ado though, so we'll go into a couple different things that I've learned over the years and things that I've used that I think help gives a little bit of an advantage, and I can show you some of my charting, some of my reasonings, and everything else as we go. So the first one that you see on the screen is one of the most popular mathematical terms that you may have probably heard at least in one math class in your life, and it's called the Fibonacci sequence. Now, the Fibonacci sequence is very interesting because you actually see it in the world around us without even really knowing it. So I'll show you some examples about how that's going to work. But I'm going to show you how we can use the Fibonacci sequence, what it is, how you can use it with stock markets, with the charting and everything, which is what I've been doing with my ChatGPT trading challenge. So the Fibonacci sequence is a sequence of numbers starting with 0 and 1 and steadily increases where each number is equal to the sum of the 2 preceding numbers. So as the example, this is what we start with. So starting off with 0, 0 plus 1 makes 1. That's the next one, which is right here. 1 plus 1 makes 2. That's the next number. 1 plus 2 is 3. 2 plus 3 is 5. 3 plus 5 is 8. That is the Fibonacci sequence that you are essentially seeing. This formula, I don't like to look at this kind of stuff, but it's basically saying, hey, these two numbers, 2 and 3, make up the next one. These two numbers, 3 and 5, make the next one, so on, and so forth. It is the Fibonacci sequence. Now, with the Fibonacci sequence comes what's called the golden ratio. And maybe you might have heard it in a math college class potentially. I don't bring it up that much to my high school students about the golden ratio, but believe it or not, I don't teach the geometry sections, but I believe they do cover it in geometry, which is pretty fascinating. So we have the golden ratio of 1.618. Now, it is used in a lot more than you might possibly think. The quotient between each successive pair of Fibonacci numbers in the sequence approximates 1.618, or its inverse 0.618. And again, I'll break down the math to it, don't worry. So a lot of math going on here, but you do see it a lot in things like nature and things like art, rectangles, dimensions, those kind of things, and how it works. So here's basically what it is. And the most common one that you might see is like a seashell or a conch shell. Essentially, this is kind of what the visual is of the Fibonacci sequence and the golden ratio. Here's the formula behind it, but I'm like, not really. Here's the nice little like seashell you might see. And this is kind of giving you the breakdown for it. So if we take the 2 consecutive numbers, so consecutive means they're together. So 5 divided by 3 is 1.66 repeating. Then take the next ones, you can do 21 and 13. Divide those, you get 1.615, blah, blah, blah. And you can keep going and going and going. And even if, for example, 89 divided by 55, which is 2 consecutive numbers, if you keep following this sequence, gives you basically the golden ratio of 1.61818, so on and so forth. And you do see it in the real life. You see it in honeybees, which I didn't even know about, which is crazy. You see it in sunflower seeds. You see it in pine cones, apparently, flower petals. The shells that you might see on the beach is based on the Fibonacci sequence and the golden ratio, which is pretty interesting. This is what I found interesting, though, is with faces. If you were to take the height of the face, like your face, from the top of the head to the chin, and divide it by the width of your face, you can approximate the golden ratio. Crazy, right? This golden ratio is so important, and you see it all over the place, which is crazy. Hands and arms proportions may show a correlation with the golden ratio. Again, the length of your forearm, the length of your hand, for example, fingers, DNA. Like the Fibonacci sequence and the golden ratio is like everywhere. So it's like absolutely crazy. And now you're wondering, how does this apply to the stock market? Well, what we have and what I use in my ChatGPT challenge is the Fibonacci retracement levels. Now, what does that mean and how can I use it? So the Fibonacci retracement levels, what I'm looking at here, again, one of the kind of defines it as is just saying you have some support and some resistance levels. Now, the retracement amounts are based on numbers identified in a Fibonacci sequence. So kind of bringing back the idea there. The levels are 23.6%, 38.2%, 61.8%, which, again, if you think about it, your golden ratio is the inverse is 0.618, which is the 61.8% golden ratio retracement. And then not officially on the Fibonacci ratio, but 50% is also used as well. And how does this essentially work? Again, here's the most common levels that you'll see when you draw out your Fibonacci retracement. So what I'll show you is an example, and the one I traded on recently was Peloton this week with my ChatGPT trading challenge. And what you will see is you can set up your Fibonacci retracement levels. So what I do with my levels here is I say, okay, well, I look for a recent high point where it swung high, and I look back down to where it retraced, which is the retracement level, right? And I draw my charts here, and what you'll see is I have two colored boxes here. And what you will notice is if I can click on the settings here, let me get the settings for you guys. So here are your default generic Fibonacci retracement levels. 50% right there. Golden ratio 61.8%. A lot of people trade these two levels here of yellow and red, which is why I color coordinated mine to be 50 and 61.8%. But again, you're basically looking forward to retrace to these levels and see what it does. As you will see with Peloton, it actually follows these support levels pretty nicely. Has a nice little rejection here, breaks down, really broke down after here, so maybe you could rechart this again. But then again, it rose back up, it broke through those nice golden levels there, hit a nice little high point here, retraced back to the golden ratio section, started consolidating, broke down again. Like, you can really see that the Fibonacci retracement is a very useful tool if you know how to chart it correctly. And that's what I've been doing with my ChatGPT challenge. I'm not just blindly going into it, but my focus is saying, now that I have these stock picks from the internet and ChatGPT and AI, which ones look good to me, and I look at drawing out my Fibonacci retracement levels. And they really do help me get an indication as to, okay, are we at a support or are we coming back down for resistance? So that's kind of how you can use what's called the Fibonacci retracement, which again is crazy because we talk about this in math and we see it all the time without even knowing it. So if you're watching this video, feel free to measure the height of your face, measure the width of your face, and I'd be curious to know if you have a Fibonacci, the golden ratio from the Fibonacci sequence. So that's one thing that you can use as a mathematical person is your Fibonacci levels. You might hear that, and where it comes from is all this crazy. I love it because it just connects, right? So it's absolutely awesome. I love it. So there's the golden ratio for it. The second thing that we focus on a lot in my AP statistics class, because the first one was Fibonacci, which we don't talk about in my classes usually, is standard deviation. We do a lot with standard deviation in AP statistics class, and if you talk about it, and if you took AP stats, you would basically know how basically it works. So your standard deviation is just a measurement that looks at how far away you are from the mean of the set. Now, as you know, with charting, you have the EMAs, you have all these different kind of averages, moving averages. You have the VWAP, which is averages and stuff like that. So you have all these different things that focus on averages. And standard deviation that we talk about in statistics focuses on, hey, how far away are you from where the average should be at? Okay, that's basically what you're looking at here. So the farther away you are from the mean, the higher your standard deviation is going to be. That is essentially what it is and how we are looking at doing it. Now, what it does and what's important is that when applied to the annual rate of return of investment, it can provide information on the investment's historical volatility. So it could show how far away you are from the average, and you can use this to kind of give a nice indication as to, okay, is it going to retrace back? I know people talk about mean reversion a lot, and it's an awesome topic to think about, whereas usually as stocks go up or they go down, they kind of tend to at some point revert back to the mean, revert back to the middle, to the average, and those kind of things there. And we're going to talk about how that's going to work with what is called the Bollinger Bands. The Bollinger Bands focuses on standard deviations. Again, you're looking at how far away you are from the average, from the mean. In this case, the Bollinger Band is based on 2 standard deviations away from your simple moving average, which is your mean. And now how the Bollinger Bands works, And you can go on Investopedia and read up all these different ways to look at it here. But this is how I essentially like to look at it. So taking a stock like, say, NVIDIA here, for example. NVIDIA's got earnings coming up soon, so might be a good little thing to kind of idea to look at here. If you click on the Bollinger Bands tab here, what you'll see is that it comes in with the average, with the length of 20, so the moving average of the last 20 trading days, and the defaults as a width of 2. Basically, what that means is your standard deviations above and below the mean. So it gives you this kind of like interval. So here's the mean in the middle, right, which is this purple line right here. And then the white line is 2 deviations above, and the yellow line is 2 deviations below. So it kind of covers both aspects in that point. What you could do is you could make this go a lot bigger and have it be wider, because again, the bigger the width, the farther away you're going to be in this case. But default, usually people say is 2 is usually pretty okay. And what you like to look for is what is happening with the stock and how it can basically predict volatility, because standard deviation in my stats class we talk about is your variability, how far away you are from the mean, how likely are you to be that far away from the mean in this case. And it talks about variability, which in the stock market focuses on volatility, right? Similar idea. And volatility means you're going to have some crazy price fluctuations. So what you will notice here is if you take a look at NVIDIA, for example, even over the last couple of trading days, so this was the 18th, 19th, 20th, so basically all of last week here, basically trading pretty okay. You know, it goes to the higher part, retraces back to the mean, goes to the lower part, retraces back to the mean, so on and so forth. We had that insane day yesterday of just bleeding out. Everywhere was blood in the markets, blood in the streets, you name it was there. And what happened was NVIDIA had a solve of 4%. Now, what you notice with the Bollinger Bands is that if they're really narrow, that means there's not a lot of volatility happening. When they expand, like this crazy expansion, that means you're getting a huge move in the volatility because you are moving farther away from the average here. And as you can see, this is 2 standard deviations away, which is very, very far away in the statistical world. And it is breaking out past that. So you're getting this huge move in the volatility. And it just follows this trend down, because what the Bollinger Band does is it expands when you have more volatility, and it contracts when you have less volatility. So here there wasn't a lot of volatility. Boom, big day, market breaks out into a huge sell-off here, and you see the Bollinger Bands expand. It's standard deviations away from your simple moving average. You can take a look at it in all these different aspects here. Same thing. Again, just kind of trading like nothing too crazy here. A little bit of a volatility here, and then a big volatility move right here. Another big one right here. So you can see that NVIDIA does trade at a pretty high volatility day in and day out. We know we have earnings coming up here, so here's what my guess is going to be. Over the next couple days, these Bollinger Bands are going to contract, right? And you already see them starting to kind of contract and kind of pull back in towards the middle here. The reason why is because earnings are coming up, I believe, what was it, the 26th, which is today's Saturday, so Sunday, Monday, so I think it's Wednesday. So you're looking at Wednesday of next week is earnings. So the next couple days might be some pretty like less volatile days because it's building up to earnings here. And then you're going to probably see after earnings come out, these Bollinger Bands are going to expand and show that volatility in the stock as a result. So when the market is kind of trading and it's kind of doing like, you know, just keeping it compact, keeping it compressed, keeping it tight and everything like that, that means that you're probably going to be due for some point to have a huge sort of expansion, which you'll see here. Narrow, 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 boom, expansion. So Bollinger Bands focuses on volatility, focuses on variability, all things we cover with standard deviations in the AP statistic field. So another kind of popular thing I like to look at is Bollinger Bands. You can look at it from a longer term perspective. Obviously, you can look at the week out. Again, they're getting a little bit more narrow here. Here's where it was narrow, and then boom, look at this big pop. You get to the upside here, probably after earnings. Big pop to the upside here. Bollinger Bands expand, showing that volatility that you're having. So if you start to see NVIDIA kind of have a little bit of like narrowing on the longer time frames, you might be looking to expect some sort of bigger expansion towards at some point soon. So that's kind of the idea of how standard deviation works and how Bollinger Bands works. There's a lot of things behind it. Now, the only thing that's a problem with Bollinger Bands, as you can see, here's the tightening versus the expanding. The only thing is that Bollinger Bands is a lagging indicator. That's the big problem I have with it. So it doesn't mean it updates, like it's not perfectly for timing. It lags a little bit behind the market. So it's probably usually going to be more beneficial to use in longer time periods, not for looking at day trading potentially, because again, it is falling a little bit behind in how the market works. I would line it up with other indicators as well if you're looking to use it. So that way you have multiple ways of showing proof that, hey, your trade's really set up and it's good to go. Just relying on Bollinger Bands will not be a good, successful trading strategy. So look at other things. They do use it. They mentioned in here, what do they mention? I think they mentioned like using like RSI works, which we'll do another video on. The MACD is another one you can look at. Volume indicators, looking at patterns and trends, strength, direction, all that kind of stuff there definitely is important as well. So don't just rely on Bollinger Bands, but it's a good thing to look at. And again, I show my AP stat students this all the time, and they kind of get this idea of like, oh my God, yeah, here it is in the real world. So that's the second kind of thing I look for as a mathematical brain. So right now we've got Fibonacci, we've got standard deviations with the Bollinger Bands. The last one to me is not a trading strategy, but more of an investing strategy and a long-term one here. And what we're going to be focusing on is the correlation coefficient. Now, what you will see is this is basically in statistics. You look at scatter plots, you look at these kind of values. You might have learned this maybe in high school if you're watching this. And again, if you are watching this, thank you so much for watching. I appreciate it for watching this far. When you look at these values here, we have three different types of correlation. You have a positive correlation, a negative correlation, and then you have no correlation whatsoever. Now, highest you go is 1 for a positive relationship. -1 is the lowest for a negative correlation. And then if you're at 0, you have nothing whatsoever. And again, what this basically means is it shows how strong the relationship is between data values. So how much of a connection is there between two variables? Positive, negative, is there no correlation whatsoever? That kind of idea is what we're looking for here. So that's kind of the basics as to how correlation coefficient works. And we do teach this in AP statistics class at the high school level. We don't go that much into it, but we do talk about it. And the reason why I bring it up is because it actually connects to what's called the beta of the stock market. So the beta in a stock market is measured on a individual stock price's correlation to the broader market, obviously, or most often using the S&P 500 as a benchmark. And 1 is the stock market movement. So if you have a beta of 1, if a stock has a beta of 1, that means that the price is correlated very close to the stock market. Not a lot of risk compared because you're going to be moving with the stock market. So again, adding a stock to a portfolio with a beta of 1 doesn't add any risk, but does not give you more return. Because again, you're moving with the market. If you want to beat the market, you want to have a beta that's a little bit higher, right? If you want to kind of sit back and do more passive approach, you want a beta that's lower than 1, for example. And we'll look at some different types of charts here and everything, how it works. But again, a beta greater than 1 indicates the market security price is theoretically more volatile in the market. For example, if it's 1.2, then we assume that 20% more volatile in the market. Technology stocks and small caps have higher betas compared to this, right? Some stocks even have a -1, just like they have negative correlation, you have negative beta, which, is focusing on those inverse ETFs, those put options have a negative beta. They go the opposite way of the market. It's the negative correlation aspect as an idea. And I can give you some examples here, just kind of wrap up the video here as to how this works. So if you're looking at investing and you're looking at investing for 20, 30 plus years, and you're willing to take on more risk, looking at stocks that have a little bit of a higher beta is definitely not a bad approach to go. If you're on your way to retiring, you're in your 50s, you're looking at starting to kind of dial it back a little bit, you probably don't want to have your investments focused on betas higher than 1. Okay. And I'll give you an example. NVIDIA, obviously everybody knows NVIDIA. NVIDIA's beta for the last 5 months or 5 years monthly is 1.62. So, which means it's moving a little bit more than half. It's moving like 62% more. It has more volatility compared to the S&P 500. So if your money is in the S&P 500, NVIDIA is going to move a little bit more compared to that. Again, a growth company, one of those companies that has more potential for the long term. So if you're looking at 20, 30 years, a higher beta isn't that bad. We can look at Apple. Let's see what Apple's is at right now. Apple has a beta of 1.2. So a beta of 1.2, again, it's not as volatile as NVIDIA. It's a little bit more volatile compared to the stock market, to the S&P 500, but it does give you a little bit more room for growth. If you're looking to retire soon, you want to look at dividend paying companies, for example. I know Procter & Gamble is a huge one. This one probably has a beta less than 1, 0.44. So very safe haven stocks here like Procter & Gamble. Verizon's another one where it's very, very safe and passive for that approach, also 0.44. And what you'll notice usually is when the market gets into fear territory and gets into correction land in a bear market, is you'll see money flood to these kind of stocks that have betas that are super low. The reason why is because A, they usually pay dividends, so you get passive income still for it, so a little bit of a return, and B, it's not going to move as much of the market. So the market goes down, say, for example, the market was down 1.71% yesterday. Verizon was up 0.64. I don't know what Procter & Gamble was up at. Let me see. Procter & Gamble was up 1.81%, which is honestly crazy to me. I'm trying to think about other companies that we've got here. I think, I don't know, it's Walmart. Walmart's a dividend paying one. Walmart 0.55. Again, had a little bit of a sell-off. That's because of earnings, probably, because they just had their earnings announced recently on that one. But again, the idea is to flock to more of these safe haven stocks. I think Starbucks is a pretty good one. Not mistaken. I know, Zach, if you're watching this and you like Starbucks, so this one kind of basically moves with the market. So 0.99, a little bit less than the market, which makes sense because S&P is down 1.71, Starbucks down 1.4, so it moves a little bit less than the market. So in taking a look at the mathematical ideas behind it, correlation between two variables, you look at the correlation is basically the beta of your stock market. So if you're looking to have more potential growth, you might want to look for a higher beta. If you're looking at having a safer, less risk approach, you're looking more at a lower beta than 1. So thank you so much for watching today's video. If you made it this far, I know it's a long video, but hopefully it's educational for you guys. Again, the 3 major things that I like to look at when I'm trading stocks or buying and looking at investing as a mathematical brain: Fibonacci sequence with the Fibonacci retracement, standard deviation with your Bollinger Bands, and also correlation coefficient with the beta from the stocks. Thank you so much for watching today's video. I hope you guys are making money in the market as per usual. And as always, I will see you guys in the next video.